In investment, the bond credit rating represents the creditworthiness of corporate or government bonds. It is not to be confused with an individual's credit score. The ratings are published by credit rating agencies and used by investment professionals to assess the likelihood the debt will be repaid. Credit rating agencies. Credit rating is a highly concentrated industry with the two largest rating agencies Moody's Investors Service, Standard & Poor's having roughly 80% market share globally, and the big three credit rating agencies Moody's, S&P and Fitch Ratings controlling approximately 95% of the ratings business. Credit rating agencies registered as such with the SEC are nationally recognized statistical rating organizations. The following firms are currently registered as NRSROs, AM. Best Company, Incorporated. DBRS Limited. Egan-Jones Rating Company. Fitch, Incorporated. Japan Credit Rating Agency. LACE Financial Corporation. Moody Unregistered Trademark S Investors Service, Incorporated. Rating and Investment Information, Incorporated. And Standard & Poor's Unregistered Trademark S Ratings Services. Under the Credit Rating Agency Reform Act, an NRSRO may be registered with respect to up to 5 classes of credit ratings: financial institutions, brokers, or dealers. Insurance companies. Corporate issuers. Issuers of asset-backed securities. And issuers of government securities, municipal securities, or securities issued by a foreign government. Credit rating tiers. The credit rating is a financial indicator to potential investors of debt securities such as bonds. These are assigned by credit rating agencies such as Moody's, Standard & Poor's and Fitch Ratings to have letter designations which represent the quality of a bond. Moody's assigns bond credit ratings of A, or, A, BOR, BA, B, Core, CAR, C, with WR and NR as withdrawn and not rated. Standard & Poor's and Fitch assign bond credit ratings of AAA, or, A, BBB, BB, B, CCC, CC, C, D. Rating tier definitions. Investment grade. A bond is considered investment grade or IG if its credit rating is BBB or higher by Standard & Poor's or BOR 3 or higher by Moody's. Generally they are bonds that are judged by the rating agency as likely enough to meet payment obligations that banks are allowed to invest in them. Ratings play a critical role in determining how much companies and other entities that issue debt, including sovereign governments, have to pay to access credit markets, that is, the amount of interest they pay on their issued debt. The threshold between investment-grade and speculative-grade ratings has important market implications for issuers' borrowing costs. Bonds that are not rated as investment-grade bonds are known as high-yield bonds or more derisively as junk bonds. The risks associated with investment-grade bonds are considered significantly higher than those associated with first-class government bonds. The difference between rates for first-class government bonds and investment-grade bonds is called investment-grade spread. The range of this spread is an indicator of the market's belief in the stability of the economy. The higher these investment-grade spreads are, the weaker the economy is considered. Criticism. Until the early 1970s, bond credit ratings agencies were paid for their work by investors who wanted impartial information on the creditworthiness of securities issuers and their particular offerings. Starting in the early 1970s, the big three ratings agencies began to receive payment for their work by the securities issuers for whom they issue those ratings, which has led to charges that these ratings agencies can no longer always be impartial when issuing ratings for those securities issuers. Securities issuers have been accused of shopping for the best ratings from these three ratings agencies, in order to attract investors, until at least one of the agencies delivers favorable ratings. This arrangement has been cited as one of the primary causes of the subprime mortgage crisis, when some securities, particularly mortgage-backed securities and collateralized debt obligations rated highly by the credit ratings agencies, and thus heavily invested in by many organizations and individuals, were rapidly and vastly devalued due to defaults, and fear of defaults, on some of the individual components of those securities, such as home loans and credit card accounts. Municipal bonds. Municipal bonds are instruments issued by local, state, or federal governments in the United States. Until April-May 2010, Moody's and Fitch were rating municipal bonds on the separate naming classification system which mirrored the tiers for corporate bonds. S&P abolished dual rating system in 2000. Default rates. The historical default rate for municipal bonds is lower than that of corporate bonds. The Municipal Bond Fairness Act, introduced September 9, 2008, included the following table giving bond default rates up to 2007 for municipal versus corporate bonds by rating and rating agency. A potential misuse of historic default statistics is to assume that historical average default rates represent the probability of default of debt in a particular rating category. However, default rates can vary significantly from one year to the next, and the observed rate for any given year can vary significantly from the average. See also, credit risk, default, list of countries by credit rating, references. External links. What is a corporate credit rating? Investopedia.com. As company priorities shift, fewer get AAA debt rating. USA Today. Fitch says confident in AAA subprime ratings. Reuters.